stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracy Reineck, and this week I'm joined by Mark Zinski, Zacks Small Cap Analyst, to look at two small cap stocks once again. And we're returning to our favorite area, AI stocks, because that's all we want to talk about right now. So Mark has two interesting small cap AI stocks this week. And we've talked about these a couple of times now on the podcast. We diverted one time to just talk about some defensive plays, but now we've returned back to AI. So the AI story is not all about NVIDIA and the large caps, although you can find it there. This technology is being used by many other companies. And on the small side, that's where the big gains can really be found. That's where, productivity is increasing, and we're really seeing some breakthroughs now using AI technology. But where is that? We've looked at some medical areas on prior episodes, and this time it looks like we're really looking at services side on the technology side, where some services can really be improved using AI technology. So welcome back to the podcast, Mark.
Thank you, Counselor. Good to be back. And, going back to the AI again, nothing wrong with doing that.
No, nothing at all. Now, I want to remind everybody, as we've had Mark on in the past, but he is an actual analyst of our small cap companies here at Zacks. I'm a strategist, so I'm not an expert on any of these companies other than what I'm learning on my own. But he is, focused solely on small caps, not just AI stocks, but those are some of the more interesting ones in his network right now. So he's bringing us these two. And I want to remind everybody, because they're small caps, they may or may not have a Zacks rank. You get the Zacks rank if there's analyst coverage, but a lot of small cap companies don't have someone like Mark looking at them, or it just we haven't had a report generated about some of these companies, so they're not showing up with a rank quite yet. But that doesn't mean they won't in the future. This is why it's difficult to invest in small cap stocks. It's hard to get companies that have analyst coverage and or just any kind of information on some of these small caps that lets us know what's going on there. But they are publicly traded, so you can purchase these companies. So just keep that in mind. Wanted to get that out there. Okay, Mark. So I wanted to start off. You've sent me a couple of names. I took a look at these, and that's kind of our usual MO on this episode. And I wanted to start off with the first one, which is Autoscope Technologies, ticker A as in Adam, A as in Adam, T as in Tom, C as in Charles. Now, you did send me a report on this one, so we don't yet have a Zacks rank. Do you think that will change since it looks like there's some coverage on it now? Or
well, we have the Zacks micro cap research product, right?
Okay.
Which focuses on names out there that do not have any Wall Street coverage, and this name falls under that domain. So investors can click. We're going to provide a link below the YouTube link where you can access the Zacks report. So it'll have a lot of good data in there, going back 5 years, the investment thesis laid out, and the risk factors. So if I'd encourage investors that if it piques their interest to download the report and take a look at it.
Yeah. Okay. So I'm going to put it up on the screen, even though it doesn't have a rank, while we're talking about it.
So we do have an outperform. We have an outperform rank on it. We recently launched at a neutral but recently upgraded it to outperform.
Okay. That's good to know. But as you can see on the actual screen, no Zacks rank, no style scores. It does have an industry rank. So it is in technology services, which is the top 20% of all industry ranks right now. It's ranking 48th out of 245. I'm just going to scroll down to kind of leave the chart up for people to look at. Did have a spike earlier this year in 2025 and then has kind of weakened here. What does it do?
Well, we're going back to the AI video processing play. You'll recall several months ago we talked about a company called iCAD, the ticker ICAD, which was an AI software play that was analyzing digital mammography and was increasing the productivity of radiologists. And so I wanted to kind of continue on that theme. The iCAD recently got bought out at a nice appreciation, and because the human eye is pretty fallible, as we know, and so I think AI has a lot of interesting applications for processing, this visual type data that the human eye might miss. And so Autoscope Technologies, which is about a $40 million market cap. And again, very important to realize this is a thin trader, so this probably is not going to be as conducive to institutional investors. So, please be wary when you're, don't put in, market bids on this. Make sure you have limits set up. It is a bit of a thin trader. That being said, they do video and radar processing for the intelligent transportation system industry. So think about cameras that are out there monitoring traffic, looking at congestion, also doing intersection control, dictating what happens, what color the lights turn based on the traffic flows, just data analysis to understand traffic flow patterns, etc. So this is very much like what I would call a smart city play. And I think this is getting a lot of attention in the AI community because a lot of it just makes a lot of sense, right? That AI would have some good applications for this. The traffic sensor industry itself, based on the industry estimates I've seen out there, is fairly robust. I've seen estimates anywhere from 6 to 13% CAGR growth over the next several years. So that's part of the investment thesis here, that AI will have applications for managing traffic flow. Another interesting thing to note is their technology is above ground. Now, this compares to most of the existing technology, and that's about over 60% of the existing technology is what they call in pavement, right? So it's buried underneath the pavement. And of course, you can imagine to retrofit that or to repair it is very expensive. You have to close the roads, to dig this stuff up. And so that cost consideration is part of the advantage that Autoscope has because their systems are above ground, very low cost of installation, etc. Another thing to note is as part of the 2021 bipartisan infrastructure bill, there was specifically a tranche of $5 billion allocated to what they call safe streets and roads for all. And that money is specifically earmarked to prevent roadway deaths and injuries. And so Autoscope is benefiting from that funding, which is getting funneled down to all the various local government entities, like at the state level, the county level, the city level, et cetera. And that funding is slated to continue through 2026. So that's also part of the investment thesis, that you have a monetary catalyst there, an investment catalyst that can kind of help to fuel this ongoing fire. They have a very asset light model. So they outsource a lot of the manufacturing. They have a big distributor. So hence their revenue is royalty based. So you can imagine, because of that, you have a very high 90% plus, gross margin. They have over 160,000 installations worldwide. They're in over 80 countries. And they've also been very investor friendly. That spike you referenced on the chart there related to a special dividend that they announced back in February, which was $1.05 a share. They also did a special, so that spike you see there is the arbitrage playing off of the special dividend. They also did a special dividend back in February of 2024 at $1.32 a share. Now, independent of the specials, they have a 60-cent annualized dividend, which is yielding 8%. So you get paid to wait, as they say, and that's not bad. So it's always nice to have a little kicker in there, while you wait for the story to develop. I believe that I wouldn't put my money on them doing another special because they had, some short-term securities that they were able to sell off at a nice gain that they used to fund those specials. But going forward, there is enough free cash flow to fund that 60-cent annualized dividend. So I would just focus on that in terms of thinking about your income.
Yeah, that was my real question when I was looking at those yields. As someone who does like income stocks, you do start to question a bit when you see a company paying 8% and they have a market cap of only 40 million. You do wonder, like, how safe is this? Is this even close to being sustainable?
Correct. Well, again, getting back to the asset light model, right? You don't have those working capital constraints that you have with like a regular sort of widget company in terms of the inventory issues. And there's minimal capex on this, obviously, and the high gross margin. So there's a very high conversion of EBITDA to free cash flow, and so that gives me confidence to think that that 60-cent dividend is sustainable.
Now, who are their customers? Is it mainly, cities, states, obviously countries? Is that who their customers are?
Exactly.
Okay.
Pretty much, any of these local type of government entities, that manage roads and that manage traffic systems. One of their interesting products is this, and I think we've all been there before. It's this wrong way detection software that will, how many times have we seen people, going up an exit ramp, right, the wrong way? And so this technology, will be able to detect that and send an immediate alert. And there'll be a sign, that lights up basically saying, wrong way, wrong way, that kind of thing. And so, again, that's in that vein of, trying to develop these smart tech-based solutions that can help, reduce road fatalities.
Okay. I put up a chart that kind of shows Autoscope versus the IWM, which is just the Russell 2000. And this is over the last year, I believe I put up here. Yes, 1 year chart. And you can see that spike we were talking about there on the dividend, but has been outperforming the Russell, looking a little bit closer year to date, kind of tracking the same, but not as much volatility as the Russell. And then over the last month, it has been a little bit weaker here versus the Russell, which you can see is up 13% there. And Autoscope is down 4.9% over that period. So maybe this is a buying opportunity.
Well, that's a good segue because the Q1 arguably was a little disappointing in that so revenue revenue declined 30% year over year, but as you can imagine, these contracts with these local municipalities can be kind of lumpy, and there's a budget procurement process, and unfortunately that can make sales a little lumpy. And that's pretty much kind of what they alluded to in their press release is, talking about the timing and variability of sales. They don't really, they cited some economic uncertainty, but then again, I go back to that $5 billion in funding, that's, going to be available through 2026. And so I don't see any, any kind of systemic demand, weakness impacting sales. So I just think I'm going to give them a pass on just having, a bad quarter based on that. I mean, they're still profitable, obviously, and still generating cash flow, but the sales, the top line just wasn't, quite, I think, what people were expecting, and hence that's probably why the stock is pulled in a little bit here. And of course, then that maybe gets people questioning the sustainability of the dividend. But I'm just not. I see it as a one-off at this point, and that, and the investment thesis, I think, of the $5 billion in funding and the transition to smart cities, gives me comfort and confidence.
Okay. That's good to know. This one is Autoscope Technologies, ticker AATC, and we'll be sure to put a link to that report in the YouTube description box too. So check that out. Do you or any of your family own any Autoscope?
Nope, I don't own
Okay.
Autoscope at this point.
Okay. And I do not either. This is my first time hearing about these companies. Okay. So let's move on to the next stock, and it is Duos Technologies Group, ticker D as in David, U-O-T, D-U-O-T. They're also in the tech services. And I looked them up, and on their website, they said machine vision and AI, which analyzes fast moving vehicles. So what does this one do?
Again, we're going off of that theme of AI being applied to images and image processing, and acting better than the human eye, and this is no exception. So what they do, their initial product was what they call a railroad inspection portal. So you can imagine kind of this little kind of a kiosk type thing, or a station, so substation. And so the train cars don't even have to stop going through this substation. So they can be going 60 miles an hour, etc. And when it goes through that substation, there are cameras underneath the tracks that take photographs of the undercarriage of all the train cars. And you can imagine how before this was a very manually intensive process, where you had actual people trying to inspect the undercarriage of the rail cars, looking for possible defects, possible, metal fatigue, etc. But now with this technology, you can take pictures of the undercarriage, you can analyze it. Obviously, you've got a lot of historical data, and you can kind of pinpoint, typical problem spots that the data suggests that you should look at. And so I was always impressed, with the technology. And to this point, they say that they've scanned approximately 24% of the total freight car population in North America. The problem with this is they just always struggled to monetize the technology effectively. And you can imagine their customers are like, the big railroads, as well as the big rail car lessors. And I think that their capex cycles, can be a little finicky. And so they just never seem to be able to get any kind of consistent linear momentum, on a quarter to quarter basis. And that always kind of hurt the stock. Not to mention, they are always burning cash, quarter after quarter. And so, this is a case of, while the technology is great, makes a lot of sense. You can see how you can save a lot of man hours. Just couldn't get the business model down. And consequently, in 2024, they've launched 2 new businesses that are an offshoot of this, which are very interesting. One of them is what they're calling the Duos Edge AI segment. And so what this is doing is this is providing data center co-location services in the edge. And by edge, we mean within 12 miles of where the end user or devices are. So you can see that, these data centers will have applications, to support education, emergency services, AI development, things of that nature. And they're doing lots of activity in Texas. Texas, is just booming with its data centers. So they have 15 locations that they're targeting in 2025. And they claim to have a pipeline of another 150 plus locations and customers that they think they can potentially monetize. And so I think these new businesses are starting to get people interested in the stock again, especially those that were kind of frustrated and fatigued by, the original business. They think that the annual recurring revenue from this segment alone could be anywhere from 3.5 million to 65 million. So there's a huge swath there and a lot of upside there. And that, by the way, this business carries 70% gross margin. The other business related to that, again, the data centers, is a segment that they're calling Duos Energy. And it's funny because we were just talking about this last time we were in the office, Tracy. So they deploy and operate mobile gas turbines that you can use to power the data centers, which we know is a big issue. And I know that Elon's AI company has come under fire a little bit for the way they're powering their data centers with these generators. So, so that, I think, is another, interesting offshoot that they're doing. And with that energy business, they have a 5% ownership, an equity stake with this company. I can't remember. It's I think it's AR Energy. It's called. Anyway, but the asset is 30 mobile gas-powered turbines. And so they will be monetizing those out to data centers. So as we know, the power requirements for these data centers remains very much in flux and somewhat controversial, arguably. But if you're doing, especially these ad hoc data centers, you need a power source, and this is a way to do it rather quickly. I think that the stock has become very interesting because of these two new businesses and the upside potential of these two new segments. But the question again with these guys is always the cash burn. And so like this last quarter, free cash flow is a negative $5 million. They have $3.8 million in cash. And they have a history of doing raises. So if I were an investor, we have a Zacks rank of hold right now. I would give these guys another quarter, to see how these new businesses develop, because there's no question that the upside, for those is pretty tremendous. But I'd want to see a little more evidence of traction in those businesses, and a little more evidence of leverage off of their cost base, and some stronger evidence, that they can be cash flow positive and within a reasonable amount of time.
Yeah, just for some color on the size for the gas turbines, I believe that the XAI, huge data center in Memphis, is using 15 of these gas turbines, just that one location. So there's a big market out there because the local electrical grid can't keep up and can't supply the energy that these data centers need. So you have to get an outside source really to come in with something like these gas turbines in order to operate until you figure out some other way to get the energy.
And I suspect, as we know, it's probably the states that are kind of business friendly, and that aren't really thinking too hard about the power impact on the communities or the environment, that have more of a Wild West, so to speak, attitude. That's where these data centers are growing pretty exponentially, and these are accompanying products and services, that are benefiting from that trend.
Let's take a look at what this chart looks like, because we do have a Zacks rank on this one. As you mentioned, it's the number 3 hold, which is 80% of all stocks. So, that's a pretty wide swath of companies that have that Zacks rank. Just scrolling down the price consensus and surprise chart. Well, wait a minute. Let's look at the detailed earnings just to see how many analysts we might have. So we do have 2 estimates for the full year on revenue and for next year on revenue, and also on the earnings. So that's not too bad for a small cap stock. It's better than what we normally see, which is 0 or 1.
Right.
Yeah. And you can see, just like scrolling down, they're looking for a loss of 52 cents this year. But that is an improvement compared to last year, which was a loss of $1.45. And then 2026, they're looking like they are optimistic maybe to get back in the green with 3 cents as the earnings estimates for next year.
Right. The caveat, the key caveat here is, a potential equity raise here, and that is possible. That might be the last one then for some time. It's possible, that they feel, that the sales from those, especially the Edge AI segment, could be, kind of a hockey stick type of growth. and they feel they just need some, one more capital raise, and then that will help, spin off some cash for them. So, again, I think I'm comfortable with that hold rating to just give them another quarter, to see what happens. And it's funny how this story has changed, because it's changed from a railroad, um, AI labor saving video processing play to now a data center, so AI infrastructure play as well. So not only do you get a software play on the railroad inspection, but then you also get the AI infrastructure play off of the data center, um, co-location and energy, services and products. So, um, and if you believe those sales numbers forecasts on a sales multiple, the valuation doesn't look that unreasonable.
No,
So,
no.
especially if they start demonstrating some hockey stick sales growth.
Right. Yes, the sales were projected triple-digit growth this year and next year. So,
Yes. Mm-hmm.
I put up the chart of Duos Technologies, again, comparing to the Russell 2000. And year to date, it's up 6% compared to the Russell, which is still down 5. Let's see over the last month what's been going on. So it has rallied like we've seen a lot of stocks do in the last month. And it's up 26, almost 27% over the last month, whereas the Russell's up 14. Both are, pretty nice numbers here. Over the last year, while all this is going on, you could see a big breakout in the stock last fall. Is this when they basically said, we're going in this new direction?
Yeah, I think that, that was when, in 2024, is, when they launched these two businesses. And I think, with the types of, contracts they're booking, the type of personnel they've brought in that have proven experience in this industry and that have sold some of these businesses in this industry at nice multiples, that certainly got people's attention, that they would be able to come in and execute in a similar type fashion. By the way, that 5% holding is in APR Energy is the name of the company that they have the equity. Yeah. So yeah, definitely. They have a lot of stuff going on, and the question is, getting that cost structure, leveraging that cost structure better, and managing the cash burn. So, otherwise, there's some very, very, I think, strong levers in there for, potential strong growth.
And market cap of about 87 million on this one.
Yes,
and
it trades well. So
okay,
you don't have.
Yeah, it has a bit bigger volume on this one too. Average 20-day average volume is 135,000 shares. I think Autoscope was like 6,000 shares there. So it's a little bit, more accessible to the regular investor on this one, a little bit easier. Okay, this one pays no dividend, unlike the other. So that's not surprising, as many small cap companies do not pay dividends. What is surprising is Autoscope's dividend and how generous it is. So that's unusual. But you're not getting something for your patience on this one. What kind of advice do you have for people who are out there looking for small cap companies? Because it is just so difficult to get information. I will. Do we have let me look. Well, I mean, you can get some decent information about duos on Zacks.com, just, some of the basics here at least. So I'll probably maybe put a link in. We do have a research report too, but I'll probably put a link in under the YouTube description too, just to take you to this page if you're wondering how you can see Zacks.com's info on it. But what kind of advice? I think I ask you this every time you're on. What kind of advice do you have for people who are looking around for small cap stocks? That they're not on the news. They don't talk about them on CNBC or Fox Business. They're rarely even talked about on Stock Twits if they have a ticker over there. Where does someone even begin? Do they just tune into these kinds of podcasts when you're on to get some ideas, or is it, I don't know.
Yeah,
Where do
well,
they begin?
correct. Well, I've always been a bottoms up guy. I'd like to look at the individual companies, small caps as an asset class. In other words, if you were to buy an ETF, a small cap ETF, um, you need to be aware that there are probably a fair amount of unprofitable companies in there, and that as an asset class, historically, the small caps have been pretty correlated to interest rates. So if you think interest rates, are going to, kind of stay where they are, or maybe even go up, that's something to consider before you buy an ETF to bet on the asset class. And the reason it's correlated with interest rates is because of the perception that smaller companies have a harder time getting financing. That's why I prefer the bottoms up approach, where I'm looking at it on a company by company basis. Looking at the individual balance sheets, the individual industries, and to see what kind of potential macro, um, especially a macro immunity the companies may have. Like in the case of Autoscope, right? You're dealing with um, pretty much the public sector as your customer, and we know that public sector is pretty well financed. From that 5 billion I alluded to. So you could argue that it's a little bit more disconnected from the macro economy there. In the case of duos, the data, if you buy the data center growth is going to continue, and that the energy needs associated with that are going to continue, then this is definitely worth looking at. The software play on the actual rail, on the rail inspection, right, on the rail car inspection, is a little more dubious, and that's why they've added these new businesses, because they knew that they just weren't getting the kind of consistent linear performance out of that segment.
Okay. I put up, before we end this podcast, the chart of ICAD, which we've talked about in the past on this show, ICAD, and you can see the big spikes. This is a year-to-date chart, and it's up 98% because it is going to be bought out, apparently. So, but very volatile. It did sell off into Liberation Day, it looks like here, and then now is surging. So,
Oh yeah, speaking of which, before I forget too, though, small caps. If you're looking for a way, and we mentioned this in our defensive stock podcast previously, small caps tend to generate the majority of their revenue within the United States, and they tend to have most of their operations within the United States. So, on a general basis, it's fair to say that they tend to have less exposure to tariffs.
right.
And so that's also something to consider. If you're concerned about tariffs and the volatility of those tariffs, and kind of looking for ways to circumvent that risk factor, small caps are not a bad place to start looking.
Right.
because most of these companies have a domestic focus.
Right. I put up the 1-year chart also on iCAD just to see moving out a little bit, like how volatile the stock has really been, but it's now up 140% over the last year. And IWM, the Russell 2000, is up 0.5% in that time period. Never a boring
That's what you
day
hope for.
on the small cap side.
Well, it's I don't want to say feast or famine, but in general, I've spoken with some kind of what I would call old guard type guys at investor conferences over the years, and they acknowledge the volatility, in this asset class, but they've been doing it for 30, 40 years. They've survived it, and their one piece of pithy advice is the multi baggers are going to outweigh the few stinkers. I mean, try not to have too many stinkers, but there is a chance to have a lot of multi-bagger success in this space. So do your homework and do your due diligence, and hopefully, we can get more of them right than wrong, because you can only go down 100%.
Right. So do you or anyone in your family own Duos Technologies?
No, nobody does.
Okay. And what about iCAD? Did you own that one?
I think we did have.
I think you did.
Yeah.
Okay. All right.
Family member. Yeah.
Yeah. Okay. So let me recap the stock tickers again we talked about today. Autoscope Technologies, AATC. That's the one with the dividend. And Duos Technologies, D as in David, UOT as in Tom. And then we mentioned iCAD because we have to talk about our successes from the prior episodes. ICAD is that ticker, and they're going down the road to being bought out. But as always, we are going to be bringing you more stocks throughout this year. And hopefully, when it gets a little bit nicer out here in the Midwest and it's warmer and I don't have to wear a turtleneck anymore. But we will be bringing Mark back on to talk about some more stocks because he is our expert here at Zacks on small caps. And we still love them, even though the big caps are where seemingly everyone wants to be. But as Warren Buffett has always said, he wishes he were younger again with less money so that he could buy some of these small cap companies as they're starting off on their journeys. But he's just a little too big now and can't do it. But you can still buy these small caps. So we'll be bringing them to you all year long. Be sure to get us on YouTube. Go to Zacks.com/YouTube, subscribe over there. You'll get the Market Edge video podcast every week. You can also get us on audio on Apple. We're on Spotify. We're on Amazon Music, just about anywhere you can get podcasts. But be sure to get us somewhere, and I'll be back next week with some more stocks.
I'll just add, Tracy, don't forget to, I'd recommend downloading that Autoscope report. We'll put the link in there.
Okay, that's right.
For you to download, because as part of your due diligence process, I feel pretty confident that this report is going to save you a fair amount of time.
Okay.
Just in terms of being able to access all the data, the historical data is there, versus having to retrieve it yourself. I feel that that's one of the better advantages of these reports is it really succinctly summarizes the investment thesis. I mean, you can agree or disagree with it, but the data, the 5-year historical data is going to be there, so you can really look for trend analysis, and I assure you, it will save you time in your due diligence and homework process.
I'm always looking for that. I always, on these small caps, as I said, it's very difficult to find information. So if I can find a report like this, I'm definitely looking at it. So I looked at it when you sent it over to me before this podcast. So we will provide a link to it on YouTube in the description box so that all of you can look at the same thing we've been looking at. And that's always a good source of information. So thank you for pointing that out. We will include it there. So make sure you go over to YouTube. Go to our YouTube page, Zacks Investment Research, and find the Market Edge podcast there. And as always, I will see you again next week with some more stocks.